I'm Captain Hoff, CEO of Founderspace, the leading global startup accelerator. I'm also author of the award-winning books, Make Elephants Fly, Surviving a Startup, and The 5 Forces. Hunting unicorns. How do Silicon Valley's top investors evaluate startups? What criteria do they use to figure out a winning investment from a losing investment? It's easy to spot a winner when it's growing fast. Let's face it, when a startup is rocketing up, when its revenue is growing, when its user base is expanding, you can look at the startup and it doesn't take a rocket scientist to figure out this is a good investment. In Silicon Valley, most of the venture capitalists, they prefer to wait. They don't even mind paying higher valuations. They will tell you when you come into them at an early stage, they will often say, you're too early. Come back when you have traction, meaning come back when you have something to show me, real revenue growth, real user growth, something I can see so that I know your company is a good bet. And this is because it's difficult to figure out if early stage startups, before they have traction, before they really have revenue or user growth, when they're just beginning, if they are good investments. How do you know if an early stage startup is a good investment? When a startup is young, when it's just beginning, when they're developing their product, they might not even have launched their product yet. What can you look at to determine the quality of this startup? There are so many early stage startups out there. They all begin to look alike. And you only have so much money as an investor. How do you pick them? How do angel investors make their choice? How do the early stage VCs that come in at the beginning decide which investments to pick? What criteria are most important to them to judging these startups? The CEO. If there's one factor that has an oversized impact on whether a startup will fail or succeed, it's the CEO. There's no other person in the company who will make a bigger difference. Even the technology or the market or anything else, the amount of funding, doesn't matter as much as the CEO. Why? Because the CEO sets the direction of the company. And honestly, if the direction is wrong, that company will fail. You have to find just the right direction. The CEO is going to make these decisions. The CEO is going to be the one at the end of the day who says, we do this, we don't do this. Here's our vision. Here's our market. The CEO is also going to be the one that picks the core management team. The CEO is hiring those people, and those people in turn will hire the rest of the people as the company grows. So having a competent CEO from the beginning is really critical. I will tell you, if the CEO isn't good, trying to replace that CEO can be a nightmare. And usually, most investors intervene when it's too late, when things are already a disaster. So in a startup, which is very fragile at the early stages, getting the right CEO into that chair at the right time is the most important thing. Otherwise, don't invest. If the person who is CEO is not the right person, I will tell you that's a huge red flag. It doesn't matter if the company has great technology. It doesn't matter if they have a great vision. All of these things are secondary because implementation is everything. A lot of startups will have good technology. A lot of startups will have a good vision. There's always a big market out there. But without that CEO leading the way, that startup will probably not make it. But how does an investor judge a great CEO? What criteria do you use to say this CEO is excellent, this one's okay, and this one's, I shouldn't touch them? How do you do this? Well, you can look at the resume. You can see where the CEO was educated. Did they go to MIT, Stanford, Harvard? Maybe they went to a top tier school. But does that make them an excellent CEO for a startup? The answer is maybe. It means they probably did well on tests to get into the school. But, not everybody at MIT or Harvard or Stanford, not everybody there is cut out to be an entrepreneur. Some of them would be better off being scientists or professors or doctors. Being an entrepreneur is a very special thing. And just because you went to a top tier school doesn't make you cut out for it. Look at Jack Ma, one of the most successful entrepreneurs in the world. He didn't go to a top tier school, and yet he was a natural CEO. You could also look at their work history. Did they work at Microsoft or Google or Facebook or some company that's been incredibly successful? Well, the answer is those are big companies. They have thousands and thousands of employees. Not every employee at these companies will make a great entrepreneur. So just because they were at Google doesn't mean that they will be the next, super CEO, startup CEO. You have to look beyond this. What I try to do as an investor is really get to know and understand the person. What has this person done in their life that would indicate that they will make a great startup CEO? I actually ask them detailed questions. I look at their university, I look at, what jobs they had, but I want to know, what did they do in the university? What did they do on the job? How did they stand out? The people I like to see are people who are self-motivated, who go out there and take something and bring it to a whole new level. So they could have joined a club and then become president of the club and then grown the club 3 times over and won a national championship or a big award. Or they could have started their own club of something they were fascinated in and pulled in all these amazing people. Or they could have been on the job. And I don't care if they're a vice president or a project manager. What did they do on the job? Did they do something amazing? Did they bring other people in the company? Did they innovate? Did they get buy-in? Did they get resources? Did they take this project somewhere? You want to look at what they actually did, what they actually accomplished. What are their visions? What did they learn? Ask them what they learned. Did they face obstacles? Because in a startup, you're going to face so many obstacles. What obstacles did they face? How did they think about it? How did they analyze it? How did they get around these obstacles and keep going even when it seemed impossible? If I can get a sense for this, I start to understand, wow, if you put this person into a startup, they're going to do amazingly well. Whatever they do, they're going to figure out a way around it. That's when I begin to get confident that this CEO is one who can lead the company. Because remember, the CEO is like the starting point, but everything flows from the start. Everything flows from where you start. And if you don't start off in a good place, it's going to be very hard to get back to a good place, especially if you don't have the type of person with the type of mind and the leadership capabilities who can take the company all the way. So when you're thinking about investing in a startup, you can never spend too much time with the CEO. Really getting to know the CEO, how they think, how they operate, what their worldview is, and what they're capable of. The team. The team is the next thing Silicon Valley venture capitalists look at when they are trying to determine whether or not to invest in an early stage startup. I will tell you from my own experience, great teams can tell you so much about the company's chances for success. And they also tell you about the CEO. If the CEO is weak, the CEO will have a weak team. That CEO won't be able to attract the right type of people to really grow this business. And I don't care how smart that CEO is. I don't care if they're a genius. If they can't bring in the right people, they're going to fail, because no single person alone can build a $1 billion company. It takes more than one person. You have to grow that company. In order to grow that company, the team you start with sets the foundation. They are the ones who end up hiring the next generation and the next generation and next generation of employees as the company matures. So a great CEO, a really good CEO, will go out there into the world and spend the time and energy to recruit the very best people. They will be pulling people. Like, I can tell a great CEO, if a CEO can get somebody to quit their job at Google or quit their job at Microsoft or another big company and come and join this startup for nothing more than an idea and some worthless shares, then I know that CEO has something. That something is called leadership, the ability to get people to do things for you when they don't have money. It's easy for me to hire a top person if I have unlimited funds. But if I have no money, just a vision, and I can attract these amazing people, top programmers, top marketing people, top designers, and I can get them on the team. If I see that, I know, wow, how did that CEO do that? That is a sign of great leadership. And that is the first step. The team also will define the future of the company, because this team is the core. This team will be leading the company forward. They will be setting the standard for all future hires. We like to say A players hire A players, B players hire B players. Do you want an A team or a B team, or a C team or a D team? You should only invest at an A team. It's your most important data point. At Founders Space, we've had startups come in there. Some of the startups, they had a brilliant idea, but the team was subpar. We looked at the team and they're not quite there. Almost invariably, these startups would underperform and usually fail. In other cases, we had startup founders come in there and they were amazing. The team was amazing. Their idea wasn't quite right, but we had faith in them. And sure enough, they figured out that this idea didn't work, and they iterated and iterated and until they hit it. And then they kept going. They did really well. So when I'm looking at a startup, I'm looking at the team. And I'm also looking at the composition of the team. I like teams that make up for the CEO's weaknesses. There's no CEO that has all the talents in the world. And even if they have all the talents in the world, they do not have all the time in the world. They're going to have to delegate their tasks to this team. So that team needs to be able to execute on it. And a good criteria in Silicon Valley for an early stage startup that's beginning is we need to see 3 types of people on the team. We need to see somebody who understands the business inside and out, who's innovating on the business model, who's pushing, who's selling the vision, engaging with customers. Usually that's the CEO. Then we also need to see a technical co-founder. Most of the startups we fund are technology based. And if you don't have somebody core to the company and the core team who has built this technology, who's hands-on with it, who really understands and is innovating and pushing it to the next level, you can't have that technological innovation. The third person is a top designer, somebody who understands user experience, somebody who can understand what the customer needs and translate that into the product. I will tell you, design innovation is a huge factor in making companies successful. When you get these 3 types of people with these backgrounds together, magic happens. If they're all talented, they will get together and they will see the world from different perspectives and come together and build something of true value. The market. I like to think of the market like a bowl. If the market is small, it's the size of a fishbowl. If it's a little bigger, it might be the size of a pond. But as a venture investor, if I am going to get a big return on my investment, I need a market the size of the ocean. That is because if I am investing in the fish in this market, if it's a small market, like a fishbowl size market, those fish can't grow that big. You cannot grow a whale in a fishbowl. You can only grow a whale in an ocean. So there needs to be a huge market for me as an investor to feel confident that this startup can become a unicorn. In the real world, when we are looking at markets, we are looking at the addressable market. What is the addressable market? You need to understand that not all markets are the same. You can come to me and say, I'm an educational company, so my market is so many $1 trillion because that is how much people spend on education in general. Well, that includes everything. Elementary schools, high schools, universities, online education, training courses. That's not your market. I am sorry. No, nobody has the entire educational market. Everybody has a part of that market. So what I'm looking for is for an entrepreneur to come to me and say, no, we are focused on training workers in this type of industry. And this is how big the market is. And for most investors in Silicon Valley especially, we aren't interested in any market that is smaller than $1 billion. If you don't have at least $1 billion market, it's not going to be worth our time. And ideally, what we like to see often is an entrepreneur starts in a smaller market to figure things out, one that they can tackle. but that leads to a bigger market and a bigger market and a bigger market. So it's like you can hop from a goldfish bowl into a pond and then into the ocean. A great example of this is Jeff Bezos. When he started Amazon, he started with just selling books, just books. It doesn't sound very big, but the book market is still pretty huge. It's a big market. But now look at Amazon. They sell everything. Amazon sells they're in the grocery store business. Every product imaginable can almost be bought on Amazon. So they've grown from what was a reasonable size market into just an enormous market. And that's why that company just keeps growing and growing and growing. This is the ideal investment. If for us as venture capitalists in Silicon Valley looking for unicorns, we want to see this. We want to see one market that leads to a bigger market that leads to a bigger market. That is the perfect trajectory for a startup. That is why don't come to us with your goldfish bowl. If you can't tell us how that fish is going to jump out of that goldfish bowl, get into the pond, and eventually into an ocean. If you can't show us that path, we aren't interested in investing. The market is just too small. The customer. Whenever entrepreneurs come to me, one question that I always make sure to ask is, who is your customer? Let me tell you a story. I had an entrepreneur come to me and I asked, who is your customer? The entrepreneur said, women. That was all the entrepreneur said. When I heard this, I knew there was a problem. Women? What type of women? You didn't tell me. Are they young women? Are they teenage girls? Are they elderly women? Are they professional women? Are they housewives? You need to tell me, as an entrepreneur, exactly who your customer is. If you don't know, if your customer is just women, your company is in trouble. I don't see how a business can become a unicorn if they don't even know who their customer is. How can you build a product for this customer that customer will love, that customer will want to use over and over and over if you haven't even figured out who the customer is? So this is why when I talk to entrepreneurs early on, I want to make sure that they not only understand exactly who their customer is, but they know a lot about their customer. The more they know about their customer, the more confidence I will have that that startup can become a unicorn. I want to hear the entrepreneur say, my customer is teenage girls. This is the type of books they read. These are the type of movies they watch. These are the type of homes they live in. This is where they go shopping. This is what they buy. The more data you can give me, the more assurance I will have that, wow, you really understand these customers. And you can probably figure out how to build an amazing product just for this segment. Now, if that segment is big enough, that customer segment is big enough, then I know that this company has real potential to become a unicorn. Customers, the time entrepreneur spends with the customer is so important. I have seen so many startups fail because the entrepreneurs are just building something without ever really getting in with their customer, without interfacing with their customer, without learning from their customer. If I'm investing in a business, I want entrepreneurs who have taken the time up front to actually go out into the world, to meet their customers, to get to know their customers, to see their customers' problems, and figure out all these different things, and then bring them back and start putting them into their business. Those are great businesses. The businesses that understand the customer are the ones that can become unicorns. Watch the waves. As an investor, I am always watching the waves. The waves are trends. These are trends that can transform our society. We can go back in time and look at some of the big technological waves that have actually reshaped our civilization. The internet, first of all, was a tsunami of a wave. It literally changed every business and industry on the planet and all of our lives. It gave birth to so many companies, so many great investments. But there are much smaller waves. There are waves happening right now around all sorts of technology. There's waves around the blockchain. There are waves around brain-computer interface technology. There are waves around space travel and all the technology being used by Elon Musk and Jeff Bezos to take humanity into space. There are waves happening we've seen waves happening in the past around mobile. The whole iPhone and Android waves, those were enormous. Literally, an entrepreneur who catches a wave has a huge advantage. If you come in at just the right time and catch that wave, for example, when the iPhone launched, when it first launched, when it was the first truly compelling smartphone that took off in a big way, you could create a little application, not even a great application because there wasn't much competition, but simply because you were catching that wave at just the right time, it would propel you and you could make millions and millions of dollars off of an application today that nobody would even bother to download. This is the power of waves. And I tell entrepreneurs out there, when you're out there, when you are like a surfer. So an entrepreneur is like a surfer. You're looking not to what waves have already happened because that's too late. If a wave has passed, it doesn't matter. You have to look to the future. What are the waves coming now that will transform us in the coming decade? And what are the biggest ones? And can you position yourself to capture it? Now, if you're too early and you start paddling much before the wave comes in with your company, you'll run out of steam. You'll run out of energy before the wave reaches you. And it won't work. Your timing is bad. And if you're too slow, if you miss that wave and the wave has already passed, no matter how hard you paddle as a surfer, you will never catch up. Entrepreneurs who launch late, once the wave is gone, they don't catch up. It's literally just like a surfer. You have to catch the wave just at the right time, and then it can take your small company of just a few people and propel it into a big business. Let me give you some examples of startups the wave has made an enormous difference. Facebook. We all know Facebook. They came around at just the right time. When people were getting online at the right time, right? In a mass number, everybody had internet access, and they allowed people to connect with each other. Now, there were a few companies before Facebook that tried social networking that didn't go anywhere, but Facebook hit it just at the right time with the right solution. And it took that company that was started, in a dorm room in Harvard and propelled it into this, multinational, enormous business. This happens over and over again. We saw it with YouTube. Before YouTube, I can tell you, I was around. I saw there were a lot of video startups, a lot of startups putting up video, but literally they were too early. Broadband wasn't here yet. Not enough people had broadband. As soon as YouTube came around, it was the perfect timing. Everybody was starting to sign up for broadband. They had the quality of the video was starting to get good enough for people to have a real entertainment experience. That was the wave that propelled them. So as investors, when we're looking at any startup that we hope can become a unicorn, we know that if it is catching a wave, it is a good investment. And that is why many investors invest in the same thing at the same time, because we're all looking out there at the future and we're all placing our bets. And we know, this company at this time has a chance to become really big. The beauty of a wave is that, an entrepreneur, if they're just out on their surfboard and there are no waves, it's only their own momentum. It's only their own energy that will get them forward. But when there's a wave, when there's something, when people are naturally doing something in society or just ready for it, and all the conditions, the infrastructure, everything else is primed, that will give them that extra push that they couldn't do themselves. A lot of times, waves are generated not just by technology, but also by the media and society and culture. Like we will be focused, culture will be intently focused on certain things at certain times, and that will drive the business, They will get a lot of attention. Look at the startups when you read every day the news. Look at the startups making the headlines. These startups are on waves, right? They're on topics that people care about. That's why they're being written about. And that in turn creates a virtuous circle where more and more people are driving to use their service. During the COVID-19 pandemic, when the coronavirus swept the world, here was a company perfectly positioned to capture. It was a disastrous wave for some, like it was wiping a lot of businesses out. But for certain companies, it was the perfect wave. Zoom, the technology company that allows people to collaborate online with video, everybody being trapped in their home, this pandemic turned out to be a wave for them, a tsunami for them. They were on the front lines of every news publication out there. People were reading about them, and people were like, "Oh, everybody's using Zoom. I will use Zoom too." So waves can come in many forms. There are also social waves, like trends, just things people are doing. There was an entrepreneur, and he was in the clothing business. Clothing business is very cutthroat. It's hard to break through. It's dominated by a few big companies, big brands like the Gap that are dominating clothing. But this one entrepreneur saw an opportunity. He saw a wave when it was small, when nobody else recognized it, but he saw it could get pretty big. And this was yoga. So he saw a lot of people starting to do yoga. And there were really no clothing brands really just focused on yoga. So he decided, let's try this. He made yoga clothing. He saw that yoga people are very passionate and they want certain things. And when he gave it to them, they would pay top dollar. This company grew incredibly fast. Now it's a dominant player in clothing in general. Lululemon. They caught the yoga wave. There's another company. Extreme sports were catching on in the United States. People love to challenge themselves. They, running obstacle courses, really pushing their limits, crawling under barbed wire, doing something that they never thought they could do and feeling that sense of achievement. Well, Tough Mudders came along. They saw this. They started running these extreme competitions that were crazy. You're crawling through mud, you're scaling walls, you're doing all this stuff, you're avoiding electric shocks. They capitalized on this trend of extreme fitness and made a name for themselves and grew and grew and grew. So whatever the business, as an investor, if I'm looking for unicorns, I'm also looking at the waves, and I want to see that they have caught the wave. The secret sauce. This is the next thing I look for in a startup. When an entrepreneur comes to me, I always ask, what is your secret sauce? And what I mean by this is, what do you have? What's so special about your company that none of your competitors have? This could be knowledge, key knowledge about what the customer needs. It could be a new technology that allows the customer to do something different or radically better than they were doing it. But I need to see that, and it cannot be a feature. Let me define this. Features take an existing product and make it better. A secret sauce actually adds a whole new value to the customer that they cannot get from the existing product. People seldom switch from one product to another for a feature. We're all using different products. We might be using Gmail from Google. We might be using Instagram, but another mail application or another photo sharing application comes along with extra features. We're usually like, we don't need them. We're not going to switch. We're already using this. There's so much inertia in the marketplace. You can't get people to move over unless you're giving them something a lot better or very different than what they already have. So when they describe their secret sauce, what I need to see is that they're fundamentally giving their customer a core value that they cannot get from existing products. This means that the product they have is either very different. The customer, it might be a chat application, but it's used in a totally different way and for a totally different purpose than existing chat applications, or it's just so much better. It's not even in the same ballpark. It is exponentially better than what customers are already using. And that could be because it uses a new technology, or they figured out algorithms that allow it to optimize in different ways. But whatever it is, when the customer looks at that product, they're going to see it as fundamentally different than what they're already using. And they're going to either drop what they're using and switch over because it's so compelling, or they'll use both products. They'll use their existing products for one thing and this new product for something else. So if you're pitching investors, secret sauce is key. You must know your secret sauce. Patents. How important are patents? I will tell you, as an investor, I have to look very carefully at what the company is doing to decide if the patents are valuable or if I shouldn't pay any attention to them at all. And it may surprise you, but in most cases, I ignore the patents entirely. Why is this? Well, in certain startups, I know patents are extremely valuable. If the startup is developing a core technology, a technology that is vital to its industry cannot move forward without this technology, then the patent has extreme value. For example, if it's a company that's designing a new microprocessor that's 5 times faster than anything else out there, and it's figured out a new way to do this, that patent would be something I would pay very close attention to. The same with biotech startups or any of the core sciences. But if the startup is not focused on that, if they're a simple hardware startup or they're a software startup, more often than not, the patents aren't worth anything. They're not even worth the paper they're printed on. And I will tell you the reason why. This is because anybody can file a patent. You can go out today and you can have nothing and you can file 10 provisional patents, for a few $100s each. You can file these patents. The patent office won't even look at it. Provisional patents are really just placeholders. They're like placeholders for when you file the actual patent. So they'll refer back to them. But when you file them, they're automatically granted a provisional patent. So it doesn't mean the startup has anything. All it means is that they paid a little money and they wrote something down on paper and submitted it. When you are analyzing startups, you need to keep this in mind. Now, real patents, when they've really filed a patent and it's based on some, years of research or some great deep insight into the process or method of how things are done, at that point, that patent could be valuable. But the value of a patent really only translates into what it does for customers, what it does within an industry. How pivotal is this patent in transforming that industry? How many will other companies be able to work around it easily? I will tell you, in software, it's pretty easy to work around most patents. If you are in a software company, you can write code in many, many, many different ways. And getting a patent that really blocks your competitors is really crucial to their business. It's a rarity. It's not something that happens every day. But when I go to Silicon Valley, you look at all these companies, all of them have patents, and most of them are software patents. The other problem is that a startup, even if you have a valuable patent, even if you figured out something that is really critical to your industry, that patent won't pay off for a while. Startups are at the greatest risk of failure in the first 3 years. And honestly, in the United States, it'll take you roughly 3 years to even get the patent. Even if you have the patent, defending it costs a lot of money and sucks up a lot of time. So most startups, they can't even defend the patents they have. They should be more focused on growing their business instead of blocking competitors. So having a patent during the most critical phase of growth for most startups doesn't matter. It's not important to whether they succeed or fail. In fact, putting the money, and it can cost quite a bit of money to file patents here in the US, and then you go internationally, it compounds. It's a lot of money and takes up a lot of your time. So if you're an entrepreneur and you're putting all that time and money into these patents and not your business, I'm worried. If I'm giving you money, I want you focused on your business. And honestly, at the early stages, these companies, these startups usually haven't even figured out their business. A lot of times they have to pivot or iterate several times on a business model before they figure it out. So a startup may spend a huge amount of time up front filing a whole bunch of patents, and then all of a sudden its business model changes and these patents aren't necessary for that business model. So what are they? They're not really critical to the business. You could sell them off for some money if they're really worth something, but more often than not, you've lost a lot of time and money that you could have been progressing against competitors in your business. Now, I will tell you, if I'm analyzing a startup, really going deep on that startup, and that startup is a hardcore technology startup, I will look at those patents and I will value those patents. But for over 90% of the startups out there, especially the software startups and startups doing, basic hardware and not cutting edge, those patents are a liability. Those patents are actually, a lot of times the entrepreneur will spend a lot of time and money on these patents, and then they find out, the customer doesn't really need their product. There is no product market fit. But they don't want to change because they've invested so much in these patents. So the patents actually hold them back. They keep the startup from abandoning something and trying something else. And I know from experience as an entrepreneur and an investor, the startups that try this and then switch and try that and keep running many different experiments until they can find the perfect product market fit, those are the ones that break through. The ones who kind of stick with a path aren't. So patents can not only not help a startup by draining its resources, but they can actually impede a startup from making the progress they need to make quickly enough to break through. Remember, technology alone doesn't make a startup. It's only the value that technology provides to the customer that matters. That's all that matters. And once a company takes off, once a company finds a product market fit that works, that's when they should consider filing a patent, because that's when the venture money starts flowing. They're growing quickly. They can hire more people. They have the extra resources so that they can put it onto filing patents. But before then, for most startups, I tell you, forget it. Don't waste your time. Maybe a naive investor will think those provisional patents you filed are worth something, but I'm not. Any smart investor in Silicon Valley will just ignore those patents, for most companies and say, show me the business. I want to see the business. What I care about is that your business works. Look at Facebook. When they started, they had no patents. Uber, when they started, they had no patents. Twitter, when they started, they had no patents. Most of these software companies and internet companies, they have no patents when they begin, but later, as they mature, like when Facebook went public, it acquired 50 patents. Why? It has all the money in the world to acquire patents. And the value of the patents is tiny compared to Facebook's, what Facebook is earning. And at the rate at which they're growing, they can afford to just acquire. So spending that money later is a much better idea than spending it earlier. You get a much bigger payoff if you structure a startup that way. So investors need to keep this in mind when analyzing a startup and their patents. Business model. The next thing we look at as investors is the business model. We want a business model that works. Now, there are two fundamental types of business models. Number one, the ad model, where you get paid by advertisers. And number two, the customer model, where your customer, whoever they are, pays you directly. For the ad model to work, you need to meet some fundamental criteria. First of all, for an ad model to work, typically you need a large user base. If you have a niche audience, a small user base, you will never generate enough money through ads to really hit the revenue numbers you need to hit to grow a unicorn, to grow a multi-billion-dollar business. So you look at the companies with ad models, and they're pretty broad. They reach out to everybody, like Google. Google is, most of Google's revenue is ad revenue, and almost everybody uses Google. You look at Facebook. They have over 1 billion active users. That's why they generate so much money with the ad model. But I've had entrepreneurs come into me and say, we're targeting a niche audience. We're targeting firefighters, but we want to use an ad model. I'm like, what? There just aren't enough firefighters in the world probably to generate the type of revenue to make you a venture fundable business. It doesn't work that way. If you're going to do the ad model, you not only usually need a lot of users, you also need data. You need to be able to target these users. The companies with ad models that are most profitable have the most data. This is why Facebook makes so much money. This is why Google makes so much money, because they have so much data about you. If you don't have a lot of data on the users, your advertisers aren't going to be able to target their ads to the people they need to reach to actually get transactions, and it's probably not going to be that profitable. The more data you have, the more profitable you'll become. So as an investor, we're looking at this equation. We're also looking at time on site. You may have a lot of users, but if they don't spend a lot of time on your site every day, if they don't come back often, if they aren't engaging deeply, they're probably not going to click on a lot of ads. So all of these criteria are what we take into account when judging whether a company with an ad model is viable, whether it's on track to be a great venture investment. Now let's go to the second business model. The second one is where you get money directly from a customer. There are a couple types of models here that work. You can get money from a customer once, maybe even once in their lifetime or once in a very long time, and you can still be profitable. A good example of this is the automobile industry, right? You sell a product once to a person, they might not come back for 10 years, 5 or 10 years to buy another car, maybe even longer. Depends on how long they want to keep their car. And they might not even come to you. They might go to somebody else because by that time they want a different car. But the profit margin in selling a car is big enough. It's big enough so that they can get that customer once and it's fine. They're making enough money to justify all the advertising they spend to acquire these customers and still make a healthy profit. But there are other businesses where you aren't selling something that is as profitable as a car. You might be selling a gadget, a new device you made. And the prices on these devices may range from $10 to, a few $100s, but the profit margins are usually pretty slim. And where there's competition, where you don't have a unique brand, a unique technology, the profit margins quickly, if people are out there copying your idea, everybody's producing the same thing, quickly shrink to, barely enough. Unless you're a tried and true business where you have massive distribution, you're selling laundry detergent. Laundry detergent may not have the biggest profit model, but you have all the distribution channels, or you're a big electronics maker and you're putting your products everywhere like Sony, then you can make money even off new gadgets, right? Because you have a brand, you have all these things, you have economies of scale. But if you're a startup and you're coming to us with this new gadget or this new thing that people buy once, and most of the time they never buy again. So the typical thing, a lot of startups put up their products like a smartwatch or whatever it is, they put it up on Kickstarter, and then they expect to have a big business. Like Pebble, they started with their smartwatch. They put it up on Kickstarter, they're a startup. They made lots of money. They got, a huge amount of advanced orders. So it seemed like, wow, this is a great business. But the problem with this is you only sell it once. You just sell it once. And then there are so many other people making similar products. How do you stand out from the crowd? And there's people who will undercut you in price. So every time you want to get a new customer after the initial splash, maybe you got some press, you have to actually pay money. And in startups, the two biggest costs that most startups have are their employees, the talent they hire, and their customer acquisition costs. How much does it cost them to acquire a customer? If you're spending fundamentally more on acquiring customers than you are making in profit from your product, you have a broken business model. And I have seen so many startups that they look great on the surface, but every time they want to get a new customer, they have to spend more than they can make or close to what they make on their products. And they just end up burning out. They end up going away. Those startups fundamentally are broken. And even if they work, the problem with any product that you sell only once to your customer, and then you have to go out and acquire a new customer to make more revenue, is that it's a very difficult business to scale. It's once you can do it, you can scale these businesses, especially if you have a unique technology and there are no competitors and you can keep a deep profit margin, especially the more expensive the product, if the more costly the product, the more room there is for profit, then you can do it. But in a lot of cases, I see these startups that, they have an amazing product. There's definitely a need out there. They've proven people want it, but they just can't grow. They end up they shoot up, maybe they launch and then they plateau, and it's very, very tough. It's a bad venture investment. The business model that we like the most in Silicon Valley from the vast majority of startups is not a one-time sale. It's what we call recurring revenue. It means you go out there and you get a customer and they keep giving you money. And over the lifetime of that customer, even if they're giving you small amounts of money, it can add up to an enormous amount. So let's look at the successful companies are out there, the biggest and best companies, and see what business models they have. Well, we've already talked about Facebook and Google. They have the ad model, but the ad model is also a recurring revenue model. They're getting money from advertisers, but over and over and over. Well, if you're getting money from customers, you can have that same model. Look at Amazon or Alibaba. They're recurring revenue models. Every time they get a little bit of the sale, but there are enough sales that Amazon is getting money on these sales. And then Amazon and Alibaba also use advertising. They make a huge amount of money from advertising. So the combination of these two, because they have such an enormous amount of usage, adds up to a lot of money over the lifetime of the customer. You look at a company like Uber. They don't have any ad model, but every time you use an Uber, you're giving them money. So this is why investors got so excited by Uber. This is why they valued it so highly, because they saw basically that if you want to get a driver, every time you have to go back to Uber, and every time you ride in an Uber vehicle, they're making a little more money, which adds up to a lot of money over their lifetime. Now, investors in Uber may have got too excited. They may have pushed the value too high, so it had to adjust downwards. But even then, it's still a good business model. That's what we look for as investors. Fundamentally, where the lifetime value of a customer, as long as you can expect to own a customer, most customers that sign up for Amazon or Alibaba or Uber or any of these services or any of the SaaS models, they usually stick with that company pretty long if they have a good service. So we'll measure that. We'll look at, what is the lifetime of the customer? How much can you make? And then a venture capitalist will do the math. This is fundamentally doing the math and basically seeing, wow, over that lifetime, you have a really significant profit margin. And this is what venture capital is good at. Venture capital will look at the future and say, you may be losing money now. You may not be you may actually be in the red, but that's because initially acquiring the customer, it takes a while for that customer to pay for himself or herself. So it's going to take a while for these customers to mature and you to get your money back. But once they paid for themselves, everything else is profit. Like then you're really making money. So we as venture capitalists will advance you the money. That's essentially what venture funding is. It's an advance on the money, and in exchange, we are getting a share of your company because we can see in the future that you are going to become highly profitable. And what you need to do now is dominate the market, get as many customers as fast as possible. So a lot of the software as a service companies, use recurring revenue. In fact, that's the fundamental model, a subscription model. And that money can add up fairly fast because software tends to scale really well. The costs, you can have a very, very healthy profit margin in software. Software is also very flexible. You can update it, add new features, do upsells very easily. Keep charging that customer more. Software, a lot of SaaS companies scale by the number of users, by the amount of usage. All of these things bode well for that type of recurring revenue business model. So again, think of business models. They aren't that hard. If you're an investor and you're looking at startup, you can look at these fundamental principles of business models, see if they map to the startup you're looking at, and then you can start to gauge the potential. If this startup if it's a big market with a lot of users and a lot of recurring revenue, even if each transaction is very small, but you're getting transactions frequently, how much money will that add up to? Will this become a unicorn? And if it is, that's when we make the decision, yes, this is the type of company we want to invest in. Design innovation. In Silicon Valley, we pay particular attention to the design. Design matters. It used to be, in the old days, you could crank out software, it could look as ugly as a pig, and still businesses and consumers would use it because there wasn't that much competition. But in today's world, it's hyper competitive, hyper. And honestly, the consumer, the end user, they don't care about the technology underneath. I mean, they often don't even know what the technology is. All they care about is what the software does for them. And part of what it does for them is if they can't understand how to use it, if it's too hard to use, they'll just go find some other software that's easier to use. Might not be as good, but to them it's better because they can actually understand it and get something out of it. So design today rivals technology. Of course you need good technology, but you can no longer afford to ignore the design issues. This is all about the user experience. When a user comes into the software, their experience using it counts for a lot. Just ask anybody why they make a buying decision. Why do you use one app over another app? Well, this app is so easy to use. It's great, you know? This other app may have more features and all this other stuff, but you can't even figure those out, so you don't care. Let's go back in time and look at some examples. In the early days, well before, we have all these cloud sharing sites like Dropbox and Boxed, and, now Google does it and Microsoft does it. Everybody allows you to file share on the cloud. Well, in the early days, they had a similar thing. It was called X Drive. It was before Dropbox kind of broke through with their big cloud file sharing. Now, X Drive, it worked, but it was clunky. It was hard to use. The design wasn't good. When Dropbox came out, they basically took that same idea, similar technology, but they made it beautifully simple. It was so simple and easy to use that it just spread. It virally spread. And the best way for products to grow today is you tell somebody else, you're like, use this, look at this, try this. It's amazing. And people try it. It's so easy that they, again, share it with other people they know. You look at other companies that have really excelled at design. Look at Airbnb. Airbnb was not an intuitive concept. Right now we think, oh, everybody uses Airbnb. But when Airbnb first came out, most of the investors, most of the venture capitalists didn't get it. They were like, why would anybody invite a stranger into their house? I mean, that person could be a rapist or a serial killer. I mean, it would be scary. Nobody will do it. But the founders of Airbnb actually came out of the Rhode Island School of Design. They were designers. They understood that it wasn't just about enabling people to come into your home. It was about creating a community. And what they designed wasn't just a website. They designed a deep, rich community where people could rate one another, where people developed bonds of trust, where the whole community had an ethos to it, where the host had a certain role to invite people in, and the guests had a certain role. And all of this together is what made Airbnb take off. Uber, very simple. Ride sharing, everybody used to, you just call a taxi on your phone, and the taxi would come. It was easy. But Uber and Lyft, the early pioneers in this space, took it to the next level. They not only made it easy, you could pay right there, and you could see the cost in advance. That was a huge design advantage. You knew what you were going to pay in advance. So you didn't, a lot of times when you get into a taxi, you don't know how much it's going to cost, and that's stressful. Also, you don't know when it's going to arrive. You might call the taxi company, but you don't know when it's going to actually get there. On Uber and Lyft, you could see the car driving towards you. It would tell you approximately when it would arrive. These design innovations were enormous, and that's what allowed them to spread like wildfire. Whenever there's a breakthrough today, especially when it's consumer facing, but even in the B2B area, the SaaS area, design plays an instrumental role in that product taking off. That's why today, a lot of SaaS products, which target B2B, which go after businesses, they actually allow anyone to try their software in advance. And they focus particularly on design innovation. How can they innovate ahead of their competitors so that when people come and try it out, they want to use it, right? And they want to drop whatever else they're doing and use this software because it's so much easier. The last thing I want to say about design innovation is that it's something an entrepreneur can do for little or no money. Developing new technology takes a lot of time and a lot of money. A lot of other innovations take time and money, but design innovation, literally, if you have the talent, or if you have one of your co-founders, which we always recommend on the team, is a designer, then you can keep iterating on the design, making it better and better and better, and trying all these different things at a very low cost. It's really your ideas and then just putting them out there in front of the end users and getting feedback. That is the essence of design innovation. And this is why everything I've told you, design innovation is so critical. If I look at a startup, I'm an investor, other investors out there. If we look at a startup and it doesn't have good design, it's crappy design, we're like, how can this company ever become a unicorn? Because somebody else is going to do the same thing and they're going to make it with better design. So if this startup from the beginning isn't thinking about design, it's a real red flag for us. Design matters. Second place is fine. A lot of entrepreneurs out there think second place is just fine. And they'll come pitch me and I'll ask them, I'll say, can you be number one? And they're like, no, we won't be number one, but we'll be number 2 or 3 for sure. When I hear this, I run for the door. I do not invest in that startup. Trust me, you don't want to invest in a second place company. Now, why is this? Why? The world is a big place. These markets are huge, multi-billion-dollar markets. Why can't they be second? Isn't second good enough? Well, first of all, it's a winner-take-all world. In a winner-take-all world, especially with new technologies emerging, transforming industries, the winner ends up being worth exponentially more than everybody else. Look at the companies. Google, Amazon, Facebook, Microsoft. These are winners. Compare them to second, third, fourth, fifth place companies. They are worth so much more. Also, a lot of times, you don't even know who the second place one is. All of us use Google. Who's second? Well, some of us, a few, will use Bing. But after Bing, what is there? Third place, fourth place, if you're them, you're almost nothing in the search business. It's true across the board. Who is really a competitor to Amazon? Amazon just dominates that market. When you look at how technology companies grow, expand, and monopolize, they form pseudo-monopolies on markets, you really want to be first place. And this is why when an entrepreneur comes in and I ask them, can you be first place? And they'll tell me, no, we'll probably be second or third. What are they actually saying? Well, I'll tell you, there are plenty of entrepreneurs who will come in and say, I can be first place. A lot of them competing with that company will say, I can be first place. I know I can be first place. And this is exactly why. Well, out of all those companies, only one will be first place. So all the others who thought they could be first place, they will be lucky to be second place or third place. And that entrepreneur came in and told me that they were content with being second place because they knew they could never be first place. Well, they're not even going to be second place. They're not going to be third place. They'll be like 10th place, 11th place, or they'll probably be out of business. That is why I don't invest in second place companies. I am always looking for the market leader. I don't care if they can give me a much better valuation. I don't care if they think they can be fine, because I look at the technology world and it's a winner take all world. And as an investor, when you are hunting unicorns, when you are out there, when you want to get a unicorn, you only can get those unicorns usually by going for first place. Go for the companies who have something, who think that they can dominate their market. And if you're lucky, if you're really lucky, they will be the one that winds up on top. Never bet on a second place horse. Platforms versus products. In Silicon Valley, we love platforms. We love platforms much more than products. And there are a few reasons for this. When a company develops a platform, it gives them some huge advantages. First of all, what is a platform? Well, let me give you a simple example of a platform. The iOS that Apple developed is a platform. It's not just a product. Actually, originally, Steve Jobs, when he developed iOS, he didn't want to allow third-party companies to make software for the early iPhones, because Jobs, by nature, was a control freak. He thought Apple should do everything and Apple would do it better. So originally, they didn't have in their app store the ability for other companies to develop applications. This made what they were developing more a product. It was a product from Apple, a single product from Apple. That is what they were developing, the iPhone. But as soon as they opened up the app store to third parties, boom, a transformation happened. They were able to harness all the creativity, the resources, the knowledge, the insights of all these other developers around the world to create content for the iPhone, which ended up making the iPhone so much more valuable. And at the same time, they were able to share that value with all of their partners. So everybody developing applications got to sell them on the iPhone and actually make money. And even better, Apple got to take a cut of all this money and get data on all these different applications. Some of them were successful, some of them failed. This put Apple in an amazing situation. Now, if you look at most of the big companies today, the big tech companies, they are platform companies. They aren't product companies. Look at Amazon. When Amazon started, they were just an online bookstore. If they had stuck to this, where every product that Amazon sold was with Amazon did it all themselves, they didn't allow any third parties to sell products, they would have just been their own company, they would have had the Amazon website. That was their product. But they opened it up and transformed it into a platform where any merchant, anywhere, can now sell products on Amazon. And Amazon not only takes a share of that revenue, which is great, but it adds value to everybody in the ecosystem. See, platforms create ecosystem. So the customer who comes to Amazon now, even if Amazon isn't selling a certain product, there are other people on Amazon's platform that are probably selling it. So they get a much more broader selection. Price. Also, they get lower prices because all the parties, including Amazon themselves, have to compete on price to give the most value to the customer. So that's why customers keep coming back to Amazon, because it has so many products, because it has competitive prices. All of this works for the customer. And the more customers that come there, the more third-party sellers that want to get on. So it reinforces itself. This is what really good ecosystems do. And once you build a large ecosystem, it is so hard for anybody else to compete. Look, there are other online stores out there. There's some amazing online stores, but Amazon is the 800-pound gorilla. They dominate this market, the online commerce market. Why are they so dominant? Because they were the first one to figure out how to build a successful platform. And platforms have the advantage that they're a huge barrier to entry. Somebody else can copy Amazon and allow other merchants onto their e-commerce sites, making a platform, but the merchants don't even want to come because they're so far behind Amazon. Once you build a platform, you get that network effect of all the people participating. This is why it's so hard now. Google and Apple dominate the mobile industry, with Android and iOS. They built the platforms. There could be other great operating systems out there, but we won't even try them because there's so many applications, so much content for these platforms. Whenever you have a platform, you get this multiplying effect, really powerful multiplying effect, because everybody that's participating in the platform in this ecosystem is gaining value from it. And the more people that participate, the more value they gain. But the biggest winner of everyone is the platform owner. So sure, there are a lot of merchants on Amazon that can get rich. Sure, there are a lot of app developers out there who do really well, on Apple and Android systems. But the biggest winner is always the platform owner. Why? Not only can they get a share of the revenue, but they get insights. They get to see everything that's going on in their ecosystem. They have control over the future of the ecosystem. Everybody else has to adapt to what the platform owner decides. And these insights can spawn new businesses. So Amazon now, they're into everything, right? They've leveraged their platform. They keep growing it. They're doing videos now. They're doing music now. They have AWS, which they didn't have at the beginning. They're cloud hosting, on and on and on. Platforms are the answer. If you're going to have a unicorn or a huge company in the future, what you should think about is not products. You should always think that you could start with a product, start with a great product, but always look at the path towards building a platform, towards getting other people to contribute value into your ecosystem and share in that value. Build platforms, not products. Values and spirit. A lot of investors overlook this factor. They're more concerned with their bottom line. They want to know if this startup will become a unicorn. But let me tell you, the values and spirit of a company do a lot towards shaping its destiny. There are companies out there that you can see when you talk to them, when you meet the employees, when you talk to the management team, that they really have a core philosophy that's guiding the company. And this creates an entirely different momentum and environment inside the company. First of all, when you have values that bring people together, It unifies the company. It also gives them purpose. And I will tell you, most of the people out there that I know, especially here in Silicon Valley, they don't just work for a paycheck. When they have a choice, the really talented people have a choice of which companies they work for. And they don't just want a paycheck. They want something that's going to be meaningful. They view their job, because they're very motivated, as their life, right? This really matters to them. And they want their life to have values, and the same values that they share. So if you look at a company, let's say like Patagonia, when they started, they led their market. They were one of the first companies to really focus on the environment, producing sustainable clothing, building a brand. And that brand motivated their employees. Like, their employees love that company. And the way it's managed, the freedom the employees have, the creativity, the innovation they display. And then those values translate into their customers. Their products are not the cheapest products, but customers who love what Patagonia stands for will pay premium prices because what they put on their body is their values. You look at tech startups like Google. Google, from its inception, believed in giving people, their employees, freedom to try things, not telling them what to do, asking them, what can you do? Where can you go? Where can you take this company? They also always fundamentally put the user first. That was part of their core philosophy. Whatever's good for the user is good for Google. Think of the user. Don't think of Google. Everything will flow back to Google if we do what's right by our users. These core values in any startup can make an enormous difference. So when I'm evaluating a startup and its potential to really bring together its workforce, to do great things in the world, and to go out into the market, as a Silicon Valley investor, values rank up there extremely high. I also look at the spirit. What is the spirit of the people in the company? Are they happy? If I go to a startup, even at an early stage, and start talking to the employees, and some of them are disgruntled, I know there's some fundamental problems here. But if the employees really love what they're doing, if they enjoy going to work, if they don't feel like it's a drudgery, I know that these guys are going to put in the extra effort to go where they need to go. Also, when things get dicey, and in a lot of startups, it can get really tough, and they can have very many near-death experiences along the way. Those employees won't jump ship. If they believe in the values and the spirit of the company, each one and another, everybody in the company helping each other, it's like a family. These companies are the ones that tend to get through the really difficult times and actually end up emerging stronger. So as an investor in Silicon Valley, values and spirit make a huge difference in my calculation of whether or not I should put my money into this startup. Invest in visionaries. If there's one thing that Silicon Valley venture capitalists love, it's a visionary. We love people with big ideas. In fact, in California on the West Coast, we're known for that. We're known for funding crazy ideas that wouldn't get funded anywhere else in the world because people would look at them and say, that's impossible. That's nuts. Nobody can achieve that. Well, we have learned through our own experience and what has made Silicon Valley so great and such a hub of innovation is that people with big ideas, people with ideas that might even seem unrealistic or impractical, these people tend to make big change. Sometimes they don't reach their ultimate goal. Sometimes their goal is just too out there. But along the journey, going towards that goal, they are able to push through conventional thinking, break down orthodoxy, and actually start to see things and gain knowledge that other people aren't able to get. If you are locked into your industry and the way it does, and you know the limitations and you accept those limitations, suddenly you can't innovate. You can't push beyond. But the people who, when they look at a limitation, don't see it as a limitation. They see it as a challenge, something they can overcome, especially using new technologies. Those are the ones who actually blaze the trail forward. And those are the opportunities we love because those opportunities have an impact to change society, to change the world, to change business, to change everything about how we live. So if a startup founder comes to me and they have this wild idea that maybe they're going to go to Mars, like Elon Musk. I'm going to go to Mars. It sounds crazy. I'm going to take humanity there. I'm going to save the world. It's like something you would read in a science fiction novel. But just the fact that Elon Musk or somebody like him is attempting this, that this type of person, number one, they're driven. And number two, they're going to take risks and try things that nobody else would. And look at his company, SpaceX, right? Whether they ultimately achieve their goal of, setting up a permanent colony on Mars, it almost doesn't matter, because the journey along the way, he's innovating and opening up new markets and new ideas all the time with his network of satellites, with what he's thinking of doing on the moon, with the new rocket ships they're developing. All of this is pushing the industry forward. And that's what we like to see in an entrepreneur. We don't want to see a follower. We don't want people who are locked in, who only see the limitations. We want people who see the possibilities. So when you're investing, it's usually a good bet to go for a visionary. I hope you enjoyed the talk. If you liked it, you can come to founderspace.com. You can check out our latest events, contact us, and see my latest books, Make Elephants Fly, Surviving a Startup, and The 5 Forces. You can also find me on all the major social networks. Just search for Founderspace.